Hello everyone and welcome back to the channel. This is Fair Value Finder and today we're taking a look at dividends. This list that we're looking at here is a list of all of the companies who rose their dividends in the month of June 2023. So we're looking at 20 stocks, decided that they could afford to and wanted to pay out more to investors. So we see that I have 3 that are highlighted in green. And some of these stocks we've taken a look at before on the channel, Realty Income being one of them, Target, Kroger. I think that I need to take a look at Caterpillar. UNH seems a little interesting as well. So if you guys want, let me know and I'll take a look at that. I am going to be doing this monthly, the last day of the month, because I take a look at these anyway. I like to stay up to date on who's raising their dividends by how much so that I can change the numbers and the projections within my spreadsheets for how much income I expect to make from dividends for the year. And it also can show potential buying opportunities because I started out as a dividend investor. I've kind of moved more towards value because dividends aren't as impressive as they used to be. But that will change in the next year or two as the Fed starts to cut rates again. If these stocks are getting beaten down because people were buying them for the dividend, then once those rates start to get cut, they'll come back. So it's definitely where I'm looking, more shares and new positions. So these greens are because they are
exactly what we want to see from companies. We see they are raising at impressive rates. Anything under 3% does not beat inflation, not a good raise, not really what we want to see from a company. 3-4%, it's okay, it's whatever. Nothing too impressive out of that. They're just kind of raising because
they have a streak that they're trying to keep up with dividend raises to become a king or an aristocrat. And then anything over double digits, ideally, anything over 5% is what I really like to take a look at. So we see that we've got a handful of companies up here within that range. It looks like we have about 9 companies who meet this criteria. And then we have the payout ratio over here, which tells us, can they afford to be paying out a dividend such as this? If it's red, it's unlikely. So maybe there's a bit of fishiness going on with the accounting and their earnings per share over the last 12 months are just kind of weird. Or, these aren't live numbers, by the way, if you see them switching as we're going. And if you want, I can teach you how to do that in another video. But we're looking for something ideally 25 to 50%. They're not paying out too much to investors. They can still reinvest back into the business, and they've got a comfortable margin of safety if stuff does turn south. And we see within the range of what we're interested in the raises, 3 companies, and those are United Health Group with a nearly 14% raise, bringing their current yield up to 1.5%. They're a very pricey stock. So their value doesn't look like it's mostly driven by their dividend. And they're only paying out 34% of their money that makes it to the bottom line. And then we have Kroger. I have a video on Kroger. I have 2 videos on Kroger, actually. It's on my buy list. I personally am buying quite a bit of it. And we see here it is the ideal dividend stock, raising the dividend 11.5%, bringing their payout ratio to smack dab what we like to see, 33%. And then we have Caterpillar, who rose by 8.33% to a payout ratio of 38.1%. I guess we could give a little bit of attention to ODC. They are in a good payout ratio range, and they had a mediocre raise. So if we trust the management of these companies, this is mostly what we need to look at for dividends. If they're growing double digits, we can almost assume that the revenue is growing at double digits, or they're cutting expenses in such a way that this is still less than they're increasing their bottom line. And the payout ratio, hopefully they can grow their earnings per share, which gives them more room to pay out more dividends in the future. So we see here at the top, we have hotels, hosts, and resorts who rose their dividend 25%, going from 48 cents to 60 cents, a 12-cent annual raise. They're paying out a little high. It's not too much out of our range, but they could get a little bit of attention. 3.5% yield. They've got some decent numbers going on, and maybe they just expect a strong year in earnings, and that payout ratio will fix itself. And down at the bottom here, we see a lot of real estate investment trusts. Realty Income specifically, this is one that I own. This is one I have a video on if you want to go check that out. And the reason for this is there is a lot of depreciation that goes into real estate, and that kind of skews these numbers. So the earnings per share is looking lower than it truly is. And they are legally required to pay out at least 90% of their net income to shareholders. So we can almost assume that this number is 90% or above. They're kind of a different beast. Realty Income's way down here at the bottom with only a 0.2% raise, 1 cent annually, because this is their third raise this year. Every few months, they just raise their dividend by a little bit. They pay out monthly, so it compounds and it becomes something typically about 1 cent a year that they're raising their dividend multiple times throughout the year. And they pay out every single month, which is very nice for compounding. That's why I love this stock. It's one of my larger holdings. And then down here, I have a lot of math. And this is to show why the growth rate is more important than the current yield. For example, we see down here, John Wiley & Sons Incorporated rose their dividend 0.72% to a 4.07% dividend yield, a payout ratio of 584%. Now we can dig deeper into these numbers and see if it's potential buy opportunity. I doubt it with such a high yield. We want something between 2 and 4, and with such a low dividend raise, they're likely just trying to maintain their streak, and they're going to run into trouble here in the future. The stock price will take a hit, so we can almost expect it to become a yield trap based on the payout ratio and the small raise. And down here, I have why the raise is more important. Now we're assuming no growth in the market. We have one stock starting at 2.5% dividend yield, one stock starting at 4% dividend yield. The top one is raising their dividend at 11.5% every year. The bottom one is raising their dividend by 0.7. So this is essentially us comparing John Wiley & Sons to Kroger and see who performs better. In year one with Kroger, you've got a 2.5% yield. That's not bad. It's not great. It's mediocre, kind of towards the lower end of a good range. And then John Wiley & Sons pays 4%. In the next year, we see that Kroger's yield is up 0.3%. John Wiley's is not moving. And then Kroger's up another 0.3%. And John Wiley's is up 0.1%. 0.4, stagnant. 0.4, stagnant. 0.4, stagnant. And so within 5 years, Kroger is now paying out better than John Wiley. Dividends are definitely a waiting game, a long-term game. The only time that I'm ever going to sell out of my dividend stocks is if the company turns south or they cut my dividend. If they pull an Intel or an AT&T and they cut the dividend that they're paying me, I will never forgive them. Will rue them for the rest of my life. But if we start to factor in some market growth here and say maybe the market grows 1% year over year, these numbers start to look a little bit different because Kroger's still growing 0.3, 0.2, 0.4, 0.3, 0.4, but John Wiley is shrinking. They've gone from 4% to 3.9%, and that would just continue on where the market's growing faster than the dividend, so your yield is getting eaten away at. Well, if we take the average market growth of 8%, 8 to 10 is typically what you hear. Well, all of a sudden, your 4% is going all the way down to 2% over the course of these 5 years. and your 2.5% becomes 2.9%. So this is growing slower as a yield basis. But remember, there's yield on cost. So I bought these shares 5 years ago. They've paid 2.5% 5 years ago. Now they're paying 4 cents. So my actual yield on cost, if I didn't sell out of these shares, I'd be making these 4 cents. This would be my average cost for the shares. And my true yield would be 4.3%. Now, if we do the same thing with John Wiley's, we can see that you're at 4.1%. And that's why when it comes to dividends, the buy and hold strategy, dollar cost averaging is the way to go. And look for something who is raising their dividend at a rate higher than the growth in the market. You want at least an 8% to have this number going up year over year. And if you look back at your average cost, if you strictly just want to project stuff out, I could say, okay, Kroger's a better deal. I'm getting a 4.3% yield rather than a 4.1 if I were to buy John Wiley. And if we rose this up to a 10%, we just see slower growth in the dividends on Kroger and faster decline in the yield on John Wiley. Hopefully you guys enjoyed this video. You learned a bit more about what to look for in a dividend stock. A good dividend base, I think, is the backbone that every portfolio should have. So you're getting that monthly cash flow that you can use to buy new shares of different companies, and you can turn those dividends into value. Or just reinvest them and grow your dividends over time. Because I always like to go back and look at the dividends that are paid out on my dividend portfolio and just look at the immense growth that they have seen. We've taken a look at this dividend breakdown sheet before, and I mean, you can see just how many stocks that I've had paying me dividends over time. And then I have it broken down further on this dividend income sheet where you can see each year, each month, how much I was getting paid and the annual totals here. So back in 2018, I made $11.72. The very first year that I started buying stocks in August, I was 18 years old, and I was so happy to make $11.72. The next year, I made $76.38. I was very happy still. That's a few free shares of stocks at that point, especially the stocks that I was buying. 2020, $368.81. More than doubled again. 2021, almost $823. 2022, this is one of my portfolios. I've got a few that pay out dividends where I have other sheets where it's all totaled up. But 2022, 1,123. And then this year, there's a little bit of a dip. I have sold out of some stocks, kind of moved some dividend money over to value because I sold out of Intel, I sold out of AT&T, I sold out of a lot of yield traps and just dumb mistakes that I made when I was younger, starting to get into things, mistakes that I want to help you guys avoid. And this will definitely raise by the end of the year. I'd like to at least beat last year. 1,200 out of this portfolio is probably not unreasonable. I need to update this June number. It looks like I was going to make $154 in June. But I was ecstatic back in 2018 to make $11.72. And now we see I get payouts like this month. 3M paid me $24.50. I sold out of Altria. That's another place where my dividends took a huge hit. They're paying me almost $50 a month. Key, I bought heavy into. They paid me $41. So it's all about accumulating shares and just monitoring the company when it comes to dividends. And you'll be amazed at what happens. So subscribe if this is something that you're interested in, and keep an eye out for next month, where I'll be bringing you all of the raises from July and the dividend stocks that are the highest quality.